Okay, let's explore this federal income tax situation or scenario. We've got Ken. He's 63 years old and unmarried. He retired at age 55 when he sold his business, understock.com. Though Ken is retired, he's still very active. He reported the following financial information this year, and we are to assume that Ken files as a single taxpayer. All right, so what we're going to do is go through these and then list whether it gets included or not in gross income. Okay, first item is item A. Ken won $1,200 in an illegal game of poker. The game was played in Utah, where gambling is legal. All right, well, let's list item A here. All right, and this is illegal gambling. Oh, I got to put my fingers on the right keys here. Illegal income. Okay, so this is his first item. Now, even if it's illegal, if it's income, you have to claim it. So we're going to include 1,200 here. Okay. Now let's go to item B. And item B says, Ken sold 1,020 shares of stock for $32. He inherited the stock 2 years ago. His tax basis or investment in the stock was $31. Okay, so what we have to do is we have to recognize the gain on the sale. So let's do a little, well, actually, let's just do a little math here, and then I'll put it above here. Okay, so we know there was 1,020 shares. Okay, and he sold it for $32. So his proceeds would be equal to the 1,000 times 32, right? That's 32,640. I'm going to put this in here. Actually, let's just do it this way. 1,020 times 32. All right, and then we have to subtract out his basis, which was $31 a share. So we're going to subtract out the same 1,020 shares times $31. I know that's that rolled off the screen here, but if you look up here, you can see where I'm typing it. Okay, and if I hit enter, what do I get? I get 1,020. That's the correct amount. By the way, I want to format this. Let's format this whole column to look like accounting. No decimal places, though. That just gets in the way. With two decimal places, good enough. All right, so we've got a $1,200 amount and 1,020. And what do we want to call B? Well, that would be the gain on sale of stock, right? Or stock sale. Make it a little bit easier to read here. Let's widen this up a little bit. All right, then we don't need this. Let's go to C. What does C say? Ken received $25,200 from an annuity he purchased 8 years ago. He purchased the annuity to be paid annually for 20 years for $211,680. All right. Well, a portion of this is taxable. Let's 25,200, 20 years, 211,680. So we're going to have to take the 211,680 and divide it by 20 to figure out what the annual cost would be. And then we take the income less the annual cost. So item C is an annuity. Okay, so we're going to take that 25,200 and we're going to subtract. Now remember, if you can't see me typing here, look up here. All right, then we're going to subtract the 211,680 divided by 20. So we use, if you will, like a straight line approach to figure out what's our cost per year. All right, so once we do the math, we get 14,615. We really could round that to 14,660. I'm just going to put a round function in here. don't know if you guys have ever seen this. Put round, comma, 0, no decimal places, right? So you can see I'm rounding number of digits. And now it should come up to be 14,616, just what we want it to be. All right, what's item D say? Ken received $13,050 in disability benefits for 1 year. He purchased the disability policy last year. All right, so for D, he got disability. He received disability benefits for a policy he purchased last year. Well, he purchased it after he was in retirement. Okay, but the main thing is none of that is taxable. If you purchase with after-tax income, you get a benefit. It's normally tax-free. Okay, so now another way of saying that is if you purchase it yourself and receive a benefit for it, it wasn't purchased by somebody else that you receive a benefit for, like it wasn't purchased by your employer. If you're purchasing it yourself, there's no taxes on it. Right, let's look at E. Ken decided to go back to school to learn about European history. He received $520 cash scholarship to attend. He used $310 for his books and tuition, and he applied the rest toward his new car payment. All right. So basically, if he used the scholarship for school, that's okay. But the difference had nothing to do with school. So it doesn't qualify as an exclusion from income. So when we look at this scholarship situation, we have to say that you're going to start off with the 520 scholarship less what he didn't use for school, which is 310. And so $210 is included in his gross income. How about F? F says, Ken's son Mike instructed his employer to make half of his final paycheck of the year payable to Ken as a gift from Mike to Ken. He received the check on December 30th in the amount of $1,130. Okay, this is paycheck from son. All right, and for F, paycheck for son, what's really happening is you're assigning it's the assignment of income doctrine. The income is taxed to the taxpayer who earned it. The gift receipt's not taxable to Ken. Okay, he received a gift. There's a small dollar amount. There's nothing in here that says Ken needs to include this in his income. Okay, since his son, who is received the paycheck, will have to pay taxes on the earnings, even though he elected to give it to his dad. Okay, so nothing there. How about G? G says Ken received a $620 refund of the $306.20 in state income taxes his employer withheld from his pay last year. Ken claimed $13,020 in itemized deductions, and at that point, the standard deduction was $12,950. Okay, and this one we might have to take a look at in a bit more detail. Okay, so I put this little image here on the screen, right above G, the one we're looking at, and let's follow the math. Okay, so the itemized deductions with a $620 overpayment was $13,020. That's what he claimed last year. The standard deduction was $12,950, given right there. Okay, so then we have to say the reduction in taxable income with the 620 overpayment has to be considered by comparing the itemized deduction with the overpayment to the standard deduction. And then we use the greater of the two. So the greater of the two was the itemized deduction with the $620 overpayment, which is $13,020, you see right there. Okay, then the itemized deduction without the 620, becomes 12,400, right? So take the 1,320, subtract out the $620. Now I think they made this 610 here, which is wrong, but if you're working your own problem, make sure you use your real numbers. Okay, make sure you the numbers that are given with you. All right, so this one it said minus 610, but really it should have been 620. Now, then we have to say what's the greater between item 2 or 4, the standard deduction or the itemized deduction without the overpayment. Okay, and in our case, 2 is the greater amount, which is the standard deduction. So the tax benefit of the 620 overpayment becomes item 3, the greater of item 1 and 2, which is the reduction in taxable income with the 620 versus the reduction in taxable income without it. Okay, this is a perfect example of why our corporate taxes are just far more complex than they need to be. So the difference is $70, and that's what we want to show for G. Okay, so he's going to have to include $70. That represents, what do we want to call that? The state income tax refund. Okay, that would be taxable in the current year. So let me. Okay, and then H says Ken received $30,200 of interest from corporate bonds and money market accounts. Well, that's, pure investment income. The government wants that. If you save money and you earn interest, they want their share of it. Now they're letting you know it's corporate bonds and money market accounts. Okay, so this is interest income. And so we would add 30,200. All right, and then the last thing you just have to do to figure out what was the gross income is just add it all up. All right, now I'm assuming many of you are working through problems like this. And so you want to use whatever numbers you have, not necessarily the ones I've provided here. It's unlikely that if you're doing the same problem, you're going to have different numbers. All right, so I'm going to type equal sum, hit left paren, and just point to the range. And that's the gross income. Okay, so in this instance, it's 47,316. Now they also had, a couple funny numbers here, a little bit different. They use 610 and 620, so there might be some slight differences. But hopefully this shows you how you'd have to work through a number of situations to a comprehensive example to come up with gross income. Okay, hope you found that helpful.